If you've ever tried trading divergence, you already know the pain. Price keeps pushing higher, your RSI starts fading, you think the reversal is coming, and then the market keeps running like nothing happened. Or you spot a perfect bullish divergence, buy the dip, and price sinks even lower. The problem isn't that divergence is useless. The problem is that most divergence tools are either too slow, too subjective, or they leave you staring at a wavy line with no clear level to trade from. That's exactly why we're looking at the RSI Momentum Divergence Zones indicator by ChartPrime. This tool doesn't just detect divergence and call it a day. It takes those momentum shifts and projects them onto your price chart as real horizontal zones you can plan trades around. So instead of guessing, you get clear areas that behave like support and resistance, built from momentum itself. We're going to build this on TradingView, which is the platform I'm using in this video. If you haven't signed up and you want the same setup, there's a link in the description. Open TradingView, load up BTCUSD on the 1-hour time frame, then click Indicators and search for RSI Momentum Divergence Zones -ChartPrime. Add it to your chart and you'll immediately notice something different compared to normal RSI divergence tools. Now let's break down what you're actually seeing, because this indicator is a hybrid. It's both an oscillator and a chart overlay. Down in the oscillator pane, you'll see an RSI-style line and divergence labels. But here's the twist. The RSI isn't calculated on raw price change like a standard RSI. The indicator uses momentum of price as the input, specifically momentum of the close over 10 periods, and then runs RSI logic on that momentum. The goal is simple: make the signal more responsive to early shifts in acceleration and deceleration, so divergence shows up sooner instead of late. On top of that, the script can automatically scan for divergences when you enable it. It looks for the classic divergence geometry. Bullish divergence is when price makes a lower low while the RSI momentum line makes a higher low. Bearish divergence is when price makes a higher high while the RSI momentum line makes a lower high. That mismatch is the warning sign that the move is running out of fuel. Because divergence can get messy, the script also applies strict timing rules to filter noise. It only validates a divergence if the two pivot points are spaced far enough apart to matter, but not so far apart that the signal is stale. In this case, the spacing filter is built in. The pivots must be at least 5 bars apart and no more than 50 bars apart. That's a big deal because it forces the divergence to be structurally relevant instead of random. When a divergence is confirmed, the indicator shows it in two places. First, in the RSI pane, you'll see labels placed right on the pivot points. You'll get bull on bullish divergence pivot points and bear on bearish divergence pivot points. It also draws colored pivot lines so you can visually see the structure that formed the divergence. Second, on the actual price chart, you'll get matching markers at the price pivot that triggered the signal. You'll see labels like up arrow bull for bullish divergence and bear down arrow for bearish divergence. Right there, the tool marks the exact price point where momentum and price disagreed. But here's the main feature and the whole reason this indicator matters. The script takes those confirmed divergence pivots and projects them forward as real horizontal divergence zones. These zones are toggleable and they behave like living structure. When a bullish divergence prints, the indicator creates a bullish zone at that pivot area. Think of it as a demand zone created by fading sell pressure. When a bearish divergence prints, it creates a bearish zone at that pivot area. That's your supply zone created by fading buy pressure. And these zones are not just static lines that stay on your chart forever. They extend forward only while price continues to respect them. If price keeps reacting to the level, the zone stays active and keeps extending to the right. If price breaks through it in the opposite correction, the zone stops extending and turns dashed, which is the indicator's way of telling you this level is invalid now. Another thing the script does well is keeping your chart clean. You can limit how many zones are shown at one time, like keeping only the most recent zones. Once the limit is reached, older zones expire and get removed. That way, you're not staring at a spaghetti chart full of old levels from months ago. Now let's talk settings, because this indicator is customizable without being overwhelming. First, you'll see an option to enable or disable the automatic divergence detection. If you turn it on, the tool scans continuously and prints divergence labels when the rules are met. If you turn it off, you can keep the zones you already have and reduce new signals if you want a cleaner chart. Next, you'll see toggles related to the divergence visuals. You can control whether you see the RSI pane labels, the pivot structure lines, and the on-chart divergence markers. If you like a minimal chart, you can keep the zones and turn off some of the extra labels. Then you have the divergence zones themselves. The zones are toggleable and you can customize the way they look. You can adjust bullish and bearish colors separately so you instantly know which side you're dealing with. You can also adjust things like background fill intensity, line width, and transparency so the zones are clear but not so loud that they hide your candles. And one of the most important settings is the zone limit. On TradingView, it's referenced as a quantity setting for divergence zones. This controls how many active zones you'll see at once. If you're swing trading and you want more context, keep more zones. If you want only the freshest levels, reduce that number so the chart stays focused. Now let's get into how to trade with this in a way that actually makes sense on BTCUSD 1 hour without turning it into guesswork. The first mindset shift is this: you are not trading the divergence label by itself. You're trading the zone it creates because the zone gives you a level. A level lets you define entry, stop, and target. So for bullish trades, your goal is to use bullish divergence zones as demand zones. That means you're waiting for price to revisit a bullish divergence zone and show you that buyers are stepping in again. Here's the long setup. First, a bullish divergence forms and the indicator prints the bull label in the RSI pane and it marks the pivot on the chart with the up arrow bull tag. That creates a bullish zone on your chart. Now you wait. The highest probability trade isn't always right away. A lot of the time, the better play is the retest. Let price move away, then come back into the zone later. When price returns to the bullish divergence zone, you want to see respect. On a 1 hour chart, a clean way to define respect is a wick into the zone with a close back above it, or a strong rejection candle that shows buyers defended the area. Your entry trigger can be something simple and repeatable, like a bullish engulfing candle printing off the zone. Once you get that confirmation, you take the long. Your stop loss goes just below the zone, not inside it. If the zone is real support, price shouldn't live below it. If price breaks through and the zone gets invalidated, you don't want to hang around hoping. That's exactly why the dashed line behavior matters. When the zone stops extending and turns dashed after a break, that's your visual cue that the level is no longer doing its job. For take profit, keep it clean. I like targeting 1.5 times your risk as a baseline on setups like this. That keeps your strategy math healthy even if not every zone holds. You can also scale out into the next obvious resistance or into a bearish divergence zone above, because those zones often act like magnets where price hesitates. Now for shorts, it's the same idea in reverse. You use bearish divergence zones as supply zones. Here's the short setup. First, a bearish divergence prints. In the RSI pane, you see bear at the pivot. On the price chart, you see the bear down arrow tag at the price pivot that created the signal. That creates a bearish zone. Now wait for price to revisit it. When price comes back into that bearish zone, you're looking for rejection. A wick into the zone with a closed back below it is a clean sign. A bearish engulfing candle from the zone is even better because it shows sellers took control immediately. Once that trigger prints, you take the short. Your stop goes just above the zone. If it's true supply, price shouldn't break up and hold. And again, the zone behavior helps. If price breaks through and the zone stops extending and turns dashed, that's a clear sign the supply idea is invalidated. For targets, same logic. Start with 1.5 R as your base. Then, if you want a more structural target, aim for the next bullish divergence zone below or the next clean support level on your chart. The key to using this tool well is understanding what it's really doing. It's not predicting the future. It's marking places where momentum already changed first and then price followed. Those levels often become market memory zones. When price revisits them, you're not guessing. You're watching to see if the same imbalance shows up again. A quick word on expectations. This tool is designed to turn a moment of divergence into a durable structure level you can actually trade against, but no tool works in a vacuum. Use these zones with context. If you're buying a bullish zone directly into major resistance, be careful. If you're shorting a bearish zone straight into strong support, be smart. The zones give you the level. Your job is to choose the best ones based on where you are in the larger move. This is not financial advice. Everything here is for education only. Build a full plan around your own risk tolerance, backtest your rules, and always double-check your thesis before taking any trade. If you found value in this deep dive, hit the like button. And if you want more indicator breakdowns and clean, repeatable trading frameworks, consider subscribing. Thanks for watching. See you next time.